John Pavelski, co-head of North America for our opportunistic credit business. Today's discussion is titled The Intersection of Private Credit and Stressed Investing, and what it's really about is two ideas. The first is the dramatic shift that's underway in the credit markets today, and the second is the significant opportunity set we see because of it. And that opportunity is to invest in good companies with hybrid capital solutions. Let me first define hybrid capital in the way we think about it, and then explain why we're so excited about this opportunity today. Hybrid capital solutions are structured debt or equity investments. They often have elements of both that solve a need for a borrower not available in the traditional capital markets. They are of particular relevance for businesses in transition. Companies that need to delever, raise liquidity, need time to recover performance, and need a partner who can grapple with some level of complexity. In our view, the arc of the current credit cycle has created a high-quality opportunity set for this strategy, given the significant change of interest rates we've all experienced, and the investor behavior that predated this period of time, particularly from 2017 to 2021. We believe this is one of the best investing environments for hybrid capital in decades, and importantly, we think it'll continue. So let's start with a discussion on the current credit cycle. This cycle is different from the last two we've seen. If you go back to 2008 with the Great Financial Crisis and the mini cycle of COVID in 2020, there were similarities during both of those periods of time. Both periods had sharp economic contractions and a significant increase in the default rate. Both times, those conditions were met with a massive monetary policy response, both in the form of dropping interest rates to zero and significant central bank bond buying. This helped restart the economy in both cases and also the capital markets engine. These periods of dislocations were severe, but the durations were relatively short. They were actually both great environments for trading strategies because public markets prices dislocated so significantly. The current cycle, in many ways, is the inverse. With underlying inflation too high, the Fed has raised interest rates, and these elevated rates are now causing what we call a creeping level of stress in the market, particularly for businesses with balance sheets that can't withstand the higher rates. So what was the cure in the prior cycle is now the problem. We think the current credit cycle has three waves, and some waves are as expected. The first wave of distress is always the weakest links, and this time is no different. Some of the businesses that have or are on the cusp of filing for bankruptcy should have restructured years ago. The second wave in this cycle is somewhat novel. These are earlier stage, quote-unquote, disruptive business models, many of which got funded over the last 15 years and are now not profitable or not profitable enough, and having difficulties accessing incremental capital. But most importantly, we think we're in the early innings of an extended third wave, and this is where the most attractive risk-adjusted returns reside. This wave is defined by good companies with bad balance sheets, or maybe more appropriately, good companies that never anticipated 5+% base rates as an interest rate environment. The definition of distress in this cycle has expanded because of this duration. It is no longer just cyclical businesses in need of an operational fix and a change in management. Good company, bad balance sheet is the opportunity set that we're focused on. So let's briefly talk about two things. One, how we got here, and two, where we are today in the current credit environments. We are exiting an exceptional period in the financial markets over the last 15 years. And it's important to acknowledge what's happened to frame the significance of what's next. Post-financial crisis in 2009, the combined balance sheets of the European Central Bank and the Federal Reserve were $4 trillion. And if you fast forward to the end of the 2022 post-COVID period, those numbers were $18 trillion combined, with most of that increase from 2020 to 2022. Of course, you'll recall QE1 and QE2 with the overriding idea to depress borrowing rates to stimulate the economy and create the wealth effect. It was significant, it was global, and it worked. And it's actually remarkable to stand here today and reflect on the fact that in December of 2020, there was $18 trillion of negative yielding debt in the world. That's just an astonishing fact. So the markets that we've all been investing in every day, stocks, bonds, government securities, commodities, crypto, private credit, public credit, have all been buoyed by this liquidity. And this is now changing. And it's changing because we're in the midst of the most aggressive Fed tightening cycle in recent history. Not only is the balance sheet shrinking, but interest rates have increased dramatically, with base rates rising from 0% to over 5% today. Gravity, in the form of interest rates at least, has returned to Earth, and we think the implications are significant. And while I'm long out of the prediction business, but at least for a hybrid capital strategy, either a period of elevated interest rates or higher default rates, or possibly both, which could be a stagflationary environment, presents a very attractive macro backdrop for the strategy. So let's talk briefly about investor behavior. When money is free and credit conditions are lax, investors act accordingly. That's axiomatic. It was ever thus, and they certainly did so from 2017 to 2021. We saw significant transaction volume at elevated asset prices and high leverage levels. Specifically, LBO activity over the last 5 years, including COVID, averaged approximately $150 billion per year, with a peak of $229 billion of transactions in 2021. These deals were executed at prices averaging 11 to 12 times EBITDA, with leverage levels around 6 times. And importantly, the leverage levels were not only significant, but much of that debt was floating rate in nature. And as SOFR has increased from 0 to 5%, the cost to the companies has increased dramatically. And so where are we today? It's been a long time since we talked about interest coverage in the credit markets, but it's certainly relevant now. And I'll cite a recent report from Moody's that came out over the last several months. If you look at the universe of Moody's rated B3 corporates, interest to coverage, defined as EBITDA minus CapEx and interest, is expected to go below 1 times by the end of 2023. The specific metric is 0.91x. Of the 305 Moody's rated B3 companies, 188 of them are expected to have interest coverage below 1 times by year-end 2023. And while this is somewhat of a narrow sample, we think it has broader representations and implications. And the significance of this is these are borrowers in a relatively stable and growing economy that cannot cover their interest expense. And what's further interesting is the strain has just started. In 2022, the picture was far more benign. This represents a significant addressable market for hybrid capital. So let's explain the broader trend with an illustrative math example. If you take a 2021 LBO with 5 times first lien leverage and 1.5 times second lien leverage, at the time of issuance in 2021, that business was borrowing at a blended 6.4% interest rate and had significant free cash flow after interest to both grow the business or delever the balance sheet. Today, the same business roughly has an 11% cost of debt and limited, if any, free cash flow. So even operationally stable businesses that have not had any degradation in performance will experience challenge with the current interest rate environment. And we're seeing these strains in the markets today. Not only are there elevated leverage levels, but we're seeing ratings downgrades outpace upgrades by 2 times. In other words, credit quality is still getting weaker on an overall basis. And this is happening, of course, heading into what we believe is a real maturity wall, with over $500 billion of leveraged loans due between now and 2026. And of course, discussions around the maturity wall over the last few years have felt a little like waiting for Godot, but we do think this time is different given the interest rate and the overall capital markets environment. And lastly, I'll comment briefly on the relevance of the strategy from an investor perspective. We believe hybrid capital strategies are attractive today for investors for a variety of reasons. First, the strategy can access high-quality companies. These are not traditionally distressed businesses, and the old adage we believe is true: if you want to be a good investor, invest in good companies. Secondly, the strategy provides a bespoke solution not available in the broader capital markets, either the debt or the equity markets. If these companies could issue a leveraged loan, a high-yield bond, or a public convert, they would do so, but they often can't, which creates an attractive negotiating dynamic for us. So that value proposition allows us to provide a solution, and 1, to get paid for it by earning an attractive return, and 2, equally, if not more importantly, to only underwrite investments that have a significant level of downside protection. And I can't overstate the importance of downside protection in the current environment. Judicious is a word we use a lot when underwriting investments these days. And whether it's the economic outlook for the consumer, broader economic considerations, and of course, geopolitical concerns, all of those factors are uncertain at best, so we think an intense focus on downside protection is warranted, and this strategy provides it. Our downside protection is created through a combination of factors. Number 1 is the quality of the business. Number 2 is the underlying industry and competitive position. We are not accessing cyclical companies or consumer discretionary businesses or structurally declining industries. And 3, where we invest in the capital structure, there is a usual an equity cushion below our investment, which helps provide further downside protection. And lastly, we negotiate for strong structural protections that we can create through our documentation that gives us a far higher degree of control than a typical high-yield bond or a leveraged loan would. Thank you again for your time today, and we look forward to hopefully connecting in the near future.